Let's suppose you are a bank and you want to buy 10 lots in the market. You press the buy button and a pop-up appears on your platform. Not enough liquidity to execute your order. What does this mean? As you know, in the market, every buyer needs a seller and every seller needs a buyer. If someone wants to buy, they will buy from someone, right? If no one is selling in the market, how will they buy? You tried to buy 10 lots and an error appeared. This means that there are not enough sellers in the market selling 10 lots. So what will you do now? You have to execute your trade, but there aren't enough sellers in the market for your order to get executed. Now, you will manipulate. Now you will generate liquidity. How will you manipulate? Let's suppose here's the market, and you will bring the market from here to there. Now, what will retail traders do? Retail traders will draw a trend line here. They will see that the market has come to support. They will create their buying positions here. What will you do? You will make a breakout of this trend line, and their stop losses got hunted. By doing this, how did sellers get produced in the market? You must know that every stop loss order is a sell order. The people who bought in this area had their stop losses here. This means they bought and then sold at a loss. So a stop loss is also a sell order. Now, what will the bank do? The retail traders got sold here. The bank will create its entry from here. Earlier, the bank was getting its entry from here, but now the bank is buying at a lower price. This benefits the bank even more, right? Now the bank will create its entry from here. Now here, the bank made a profit and your sell order got executed. Another person's sell order got executed here. The person who sold after the breakout thought the market would go down now. They entered after the retest of the breakout and then boom, their stop loss got hunted too. Now you have to understand this psychology. Why does manipulation happen in the market? Why is liquidity generated in the market? The bank that was buying here has now bought here, meaning it bought at a lower price and also generated sell orders in the market from which it could buy. Its trade got executed, it got in at a lower price, and it made a profit. Who got trapped in between? You and me, the retail traders who buy at support and sell at breakout. This is called liquidity grab, SL hunting, and manipulation. The basic definition of liquidity is how much money flows through the market. The market with the highest money flow will have the highest liquidity and will be the most volatile pair. Basically, liquidity is the ability of a currency pair to be traded. If I tell you in general language, liquidity is equal to the number of people in the market. The more people are in a pair or a market, the higher the liquidity will be, like EUR USD, USD CAD, GBP USD, and USD Shre Gold. These are some of the most liquidated pairs. So let's start the video. Types of liquidity. There are different types of liquidity: structural liquidity, internal range liquidity, external range liquidity, equal highs liquidity, fake choke liquidity, time-based liquidity, and sessions liquidity. We will discuss each type in detail. First of all, structural liquidity. It has two types: external range liquidity and internal range liquidity. External range liquidity. Liquidity rests above every swing or all highs and below every swing or all lows. This is called external liquidity. This is a market example, and there was an old high and a swing high. The market went up, swept the liquidity of the swing high, then swept the liquidity of the old high. Here were the stop losses of sellers. As someone sold here, someone sold from here. Similarly, someone sold from here, placing their stop loss above this point. The market went up, took everyone's stop losses in one go, and then the market fell. Sweeping the liquidity of old highs and old lows outside, violating them, is called external range liquidity. This also includes the liquidity of swing highs and swing lows. Internal range liquidity. It looks like liquidity that rests between a price leg, for example, a fair value gap. That's called internal liquidity. Here, this was a swing high. This was external liquidity. The market swept the external liquidity, and then the market swept the liquidity that was inside the leg, swept the internal range liquidity. These are basically fair value gaps. We've previously explored fair value gaps in detail. If you haven't watched that video yet, I suggest giving it a look to understand the full context. For now, just remember that internal range liquidity involves filling the fair value gaps. The market always moves from external liquidity toward internal liquidity and from internal liquidity toward external liquidity. Guys, let's first look at some examples of internal range liquidity. We had a high, the market swept its liquidity, the market swept it, and then came towards eating internal range liquidity. And internal range liquidity means fair value gaps, etc. We had one fair value gap here, you can see. Then we had another fair value gap here, and the market filled it. After that, I don't think there's any fair value gap below here. The market will reverse from here. All the fair value gaps here were filled. One fair value gap was here. Sorry, the market filled these fair value gaps. Then the market made a swing low, and from this swing low, the market went up. What did the market do here? The market swept the external liquidity, then internal range liquidity. Now, the internal range liquidity has been swept. Now it's the turn of the external range liquidity. The market again went up, ate another old high, swept the external range liquidity. Then what was the market's job? To move from external to internal range. The market came to internal range liquidity to fill fair value gaps. One fair value gap was here. The market filled it. After that, this fair value gap's liquidity was swept. This fair value gap's liquidity was also swept by the market. Then there was a swing low, and the market swept its liquidity. This is external range liquidity. Here, the market swept this low's liquidity. You can see that the market is going up, sweeping external range liquidity, then coming down to sweep internal range liquidity. You can see here there's another fair value gap, and this is liquidity, then external range, then internal range, then external range, then internal range. That's how the market works. The market's job is to sweep internal range liquidity because the market has already swept external range liquidity, and now the market is sweeping internal range liquidity. So these are all fair value gaps that the market is sweeping. Currently, there is one fair value gap left in the market, which the market can sweep in the coming days. So these were the examples of IRL, internal range liquidity, and ERL, external range liquidity. Then we have equal highs liquidity and equal lows liquidity. First, let's discuss equal highs liquidity. The market was moving down, and the market made some structure like this. Here, what did the market do? The market created equal highs. Now, what will retailers do? This is a chart pattern of retailers, which they also call a double top pattern. They have learned that whenever the neckline retest happens, you have to sell here, place the stop loss above it, and your target can be 1, 3, 1 to 2, or whatever. What will the market do here? The institutes or banks see equal highs liquidity here, meaning a lot of people will sell here and place their stop loss above this level. What will the market do? The market will go boom upward, take everyone's liquidity, and the market will drop from here due to some high time frame order block or PD array, and then the market will fall. Equal lows liquidity. The market went up like this and created equal lows here. Then the market tested its neckline. Here, retailers will buy from the double bottoms neckline. And what will the market do? The market will again dump and eat up everyone's stop loss. Here we had equal lows liquidity. The market swept the external liquidity of these lows and then made its move. The retailers' stop losses were also hit. Taking money out of the market is not that easy. These concepts like chart patterns, trend lines, and support resistance, all of them are useless. These things have no role in the market. They are taught to trap you. We had almost relative equal highs here. What did the market do? The market swept their liquidity here. The people who were selling from here had their SL stop loss hunted, and here there was a high time frame mitigation block. The market gave ICT traders an entry, and it ate up the retailer's stop loss who sold here. Next, you can see the market move. This was the liquidity sweep of equal highs. These were not proper equal highs, but relative equal highs. Proper equal highs are also violated in the same way, and their liquidity is swept the same way. You can look a bit further ahead. Here you can see relative equal lows, relative equal highs. Both of their liquidity was swept, both highs and lows. Fake choke liquidity. There's also liquidity from fake market structure shifts, and in the upcoming videos, we will discuss how to recognize this liquidity. First, let's learn what liquidity is. Here's the market with an uptrend, then the market did a break of structure here. Then again, a BOS, break of structure here, and then the market broke its high-low here, meaning it made a choke, change of character. This was a fake choke. Here, there was a trap for traders. Smart money traders will place their positions here, and their stop losses will be hunted. They will get trapped in this trap. And then what did the market do? The market again did a BOS, break of structure. By giving them a big loss, the market reversed. Then the market did a real choke, change of character, a real market structure shift. Then the market shifted into a downtrend. In the upcoming videos, we will learn how to recognize a fake choke. Guys, now let's look at an example of a fake choke. Here, the market was in a downtrend. The market did a break of structure. Then again, the market did a break of structure. Then again, the market did a break of structure here. The market made a high here. So we have a choke. This was a fake choke. This was a trap for smart money traders. Those who went long here had their stop losses hunted, and the market shifted back into a downtrend. This was an example of a fake choke liquidity growls. Then we come to buy-side liquidity and sell-side liquidity. BSL and SSL are very simple concepts. We call the liquidity above as buy-side liquidity and the liquidity below as sell-side liquidity. Simple. Time-based liquidity. Then we come to time-based liquidity, one of the most critical concepts in the market. Essentially, time-based liquidity refers to the highs and lows of market sessions, such as the Asian, London, or New York sessions. Typically, the highs and lows formed during one session are swept in the following session. For example, let's take the Asian session. During this session, Asia formed a low and a high. As the Asian session ended and the London session began, the first thing London did was sweep the Asian high. This is external range liquidity being swept. After that, London swept the internal range liquidity and then it swept the Asian low. Once London closed, it left behind a new low and a high. Then the New York session opened. New York came in, dumped the market, and took out the London low. After sweeping this external range liquidity, the market moved back up toward internal range liquidity, eventually targeting the London high. Guys, this was our time-based liquidity. Example, this was the Asian session. Here, Asia made its low and high. Here, Asia ended. London opened. London swept Asia's low, meaning London swept the stop losses of Asia's buyers. Then London went up and also swept Asia's high. London swept both. Here, London closed. At this point, London closed. Then New York opened. New York, as soon as it opened, swept London's low, meaning it hunted the stop losses of traders who had bought in London. Then New York gave its move upwards and also swept London's high. The stop losses of London's sellers were also swept. This was our time-based liquidity. It's important to understand that this process doesn't mean every session will sweep both the high and low from the previous session. However, the general tendency is for each session to hunt liquidity from the preceding one. There are hundreds of strategies revolving around this principle alone. That's it for today's video. I hope you now have a better grasp of liquidity movements. In the next videos, we'll cover how to trade using these concepts. If you found this helpful, don't forget to like, subscribe, and share with your trading friends. Drop any questions or future topic suggestions in the comments below. Thanks for watching and see you in the next one. Goodbye.